exchange line 20 times. Not to mention earlier today, where did this all start? Well, Treasury yields suddenly spiked, hitting a 6-month high, only to reverse later in the session. And this comes on the heels of the German Bund, or bond world, also spiking and then pulling back. What's causing the crazy market action? What's the best way to play it in the final hour of trade? Let's get right to the floor show. Traders at the New York Stock Exchange CME Group joining us to talk about the energy market as well, because oil is a big story once again. James Cordier, founder of OptionSellers.com. Trent, let me begin with you at the CME. To bond land, why did yields suddenly start spiking?
Well, Liz, it's the relative value trade in play, and truthfully, this is no different than what we've seen driving this bust for the last 18 months. It's the first time we've seen it going with rates rising then falling. If you take a look back to the beginning of 2014, everybody felt we were going to see rates rise here in the U.S., and we got anything but. And obviously, with QE ending, people thinking the Fed was going to look to tighten, it made sense that people thought rates would go higher, but the relative value trade played, and it trumped those cards, Liz. So what we're seeing now is we're having a little reversal there with the German Bund. We were nearing 0% in the German Bund 3 weeks ago.
Right.
We've rallied about 70 basis points, and that's the first time we've really seen the cart drag the horse to the upwards with rates. But when you really think about it, it's no different than what was driving the horse up to that point in time. It's just we didn't see it that side.
But Teddy, explain why stocks fall when bond yields start to spike. It's because borrowing costs, in the blink of an eye, jump 10 basis points. Very, very quickly, and that scares the market. It's got to be more gradual, right?
Well, no, I mean, absolutely, Liz, because, you know, the Fed is, we talk about the Fed and the 800-pound gorilla and monetary authorities around the world. In a zero interest rate environment, the minute it even smells like they're about to shift gears, all of a sudden you take the equity trade off the table, and people have an alternative. Now, I would say, you know, one little move doesn't make a lifetime. But it's the perception, and I think that creates a real problem for equities, and we haven't seen that played out yet. But you know, today was really interesting because we climbed out of that hole for whatever reasons, and I mean, all intents and purposes, even probably hopefully end up plus on the day.
Okay, so yeah, let's just review here. Earlier today, the 10-year yield was at 2.36%. Now it's at around 2.26%. That's just folks, that's a wild swing. There's a lack of so-called liquidity. That means that suddenly reversals of fortune can happen almost as quickly as you can say, I'm going to sell, when the Dow was down 181 points, and now look at it. It's down just a few points. To oil, James, let's just talk quickly about why oil is spiking. Is this because the dollar happens to be weaker today, or is there something else?
Actually, there's many factors going on in oil right now. Refinery utilization, that is the burning of oil into gasoline by the refiners, is going to ramp up dramatically this driving season. Refiners right now are experiencing all-time record profit margins. This is going to reduce some of the glut supply that we keep talking about. We're expecting over the next 16 to 18 weeks a large decline in U.S. stockpiles, maybe 4 to 6 million barrels per week. That is going to take a lot of pressure off the market, and we see another leg up in prices.
Yeah, a leg up in prices. How high, James?
Fair value would probably push oil up to 68. I think we got the momentum players to push another $2. We should hit the magic $70 mark in July.
Okay, yeah. All right. Who's saying wow, Teddy?
Yeah, I said wow. You know, because Goldman Sachs put out a bearish call on oil
they did.
Again today. And, you know, it's up in their face now. You know, you don't want to necessarily bet against Goldman Sachs, but, you know, they have been wrong before when it comes to commodity
My
prices.
money's with James, because he's on the show this second.
Me too.
Goldman was very bearish at 45.
Great to see all of you. And Goldman was wrong at 45, because then we saw weeks and weeks of gains. Great to see all of you for the floor show, the closing bell. We are 48 minutes away. So who